Well, thanks everyone, and I'm very glad to be here today. It's unfortunately I can't stay for the whole day, but I'll get through this. So following on mainly from Jeff's session earlier, I'll be talking about some work we did at Cambridge Econometrics looking at the macroeconomics of basic income. So in the context of the situation we're in right now, basic income is addressing the question of inadequate income, whether now in the short term or in the longer term when thinking about more structural change. That's where we're focused on with this work. And in particular, we're interested in basic income as a systemic or structural reform as well. So that's the undercurrent of this, thinking about what reforming an economic system, taxes and benefits might look like. So just as a little bit of background, interest in basic income is not actually a new thing. I think we're either on the third or the fourth wave of intellectual interest in basic income. And right now, the factors that have spurred that have been concerns about growing inequality in the UK of the last 10 to 15 years, concerns about the nature of tax and benefits reforms, particularly in terms of the introduction of increased conditionality within the system, and also longer term, as Jeff talked about earlier, questions about automation. To what extent will we need to move in time to maybe some kind of income replacement type system, of which basic income is among the options that's been mooted. Basic income is hard to assess. There aren't too many cases around the world where it's straightforward to identify the impacts of basic income or basic income-like schemes, and for various reasons, it's quite difficult to create, let's call them test tube conditions for assessing basic income. So there are small-scale studies, there are a few pilots also running at the moment as well, but the evidence base is still relatively underdeveloped. So most of the research tends to be modelling. It tends to be looking at situations, running scenarios, what-if sorts of conditions to examine how the world might look differently under different schemes. And most of that work in the UK has tended to be on distributional concerns. So it's tended to look at what we'd normally think of as the microeconomic conditions. So what happens if you take data on households as they currently are? What happens if you shift benefits and tax structures around before and after to understand, for example, what a two-person, two-owner family with two children, what their economic circumstances would look like before or after a change in basic income. That tends to be the research focus, and what that tends to show is by re-engineering the tax and benefit structure in those sorts of ways, there are ways to redistribute income in various ways of varying degrees of progressivity, but it tends to be a static analysis. So it doesn't tell you much more than that. It tells you what happens when you move money into people's pockets, between people's pockets, but not much of what follows. And many of the criticisms that follow from basic income tend to be on the steps that follow that. So does it reduce the incentive to work? Do people withdraw from the workforce? Might it be putting money in pockets that just generates inflation? Those are the sorts of questions that are not normally answered by analyses that shift income around through tax and benefits policies. And this is the second point here. Macroeconomic dynamics don't tend to be explored quite so much. So what happens when you've put the money in lower income households' pockets, for example? What is the role of the funding mechanism? And as I'll get to, this starts to become very important. There's a lot of discourse at the moment about basic income as a payment, the amount of money that's transferred to households. But actually what matters is the basic income scheme. It's the payment, but also the mechanisms by which the payment is funded. And those, certainly in macroeconomic terms, can have their own effects as well. So it's basic income schemes that matter, not just the value of the payment itself. And while these aren't the only metrics that we should be concerned about, in terms of the exercise that we carried out here, we were interested in what happens if you look at these effects through conventional economic metrics as well. What does it mean for GDP? What does it mean for employment? What does it mean for prices? And the main channels that make this different to the existing analysis is understanding those income and expenditure effects and also how they compare to the labour supply effect. So what happens to the incentives to work if people are given an unconditional payment to supplement or replace their income? That is relevant in both supply and demand terms, and in a macroeconomic analysis we're interested in understanding both of those. So as I said, most analyses of these types are going to involve some kind of computer model. We're talking about what-if analysis, we're talking about scenarios, and for this, in our case, we maintain a macroeconometric model for policy analysis, E3ME, and what I'll be taking you through is comparisons between a baseline case, so what if the world continues more or less on business as usual trends, and then we'll compare that to cases in which we implement the basic income policies of different types, and we see where we end up in terms of GDP, employment and prices. I don't want to make this overly technical, but it's also important when you think about an economic analysis, what model or what theories you're drawing on in order to view the world. This was the point earlier about to what extent do the evidence overturn or not neoclassical hypotheses or the like. So how you think about the economy, how you think it works is very relevant to this. And in this regard, E3ME is sectorally disaggregated, which is important once we start thinking about automation and the extent to which jobs might or might not be lost through technological change. It's an econometric model, so we're using statistics to identify behaviours based on past experience, and it falls within a post-Keynesian economic theoretical paradigm with, crucially, no presumption that the economy tends to full capacity by itself. And so through that, we took two lines of inquiry. One was to try and extend thinking on existing basic income schemes, which tend to be relatively small in nature because they tend to be looking at reforms that remain fiscally neutral, and that's the policy space at the moment. So this is basic income for effectively the now. And then looking further ahead, if we were, for example, to extend Jeff's hypothesis from before about automation leading to widespread technological unemployment, what do larger basic income schemes, and in this case funded by debt-free sovereign money, what do they look like in the longer term? So we're looking at this through two lenses, through two, I suppose, different time periods, if you want to think of it that way. So what you see here is indicative of the kind of scheme that's been proposed in the UK previously. And as schemes that tend to be fiscally neutral, the idea is, as far as possible, to provide levels of payment that would be recognisable to current benefits recipients. So this schedule of payments was, I think, valid in 2019, and this is the structure of the payment in terms of basic income that we modelled, with smaller payments available to young people. Those of working age get a bit more, and those of retirement age effectively having their pension either being replaced by the basic income. And so that's the basic income payment. But as far as the scheme, and particularly in order to have fiscal neutrality, there needs to be a funding mechanism. And the typical way to do this in the UK proposed schemes is to adjust taxes and benefits to compensate for that, to, broadly speaking, maintain fiscal neutrality by reducing other benefits, which are now replaced by the basic income, and raising taxes, typically income tax, but we also examined taxes on firms as well. And those have two different effects, as it turns out. And we also examined, at this small scale case, universal payment funded by debt-free sovereign money of a scale similar to what was implied by pandemic support to households during the COVID-19 period. Sorry, I should also say that as well as modelling those payments, we did capture the reduced incentives to work that might arise from paying people unconditionally. And where we ended up was here. So in reading this chart, if a scheme had no effect at all, there would be a flat line running at 0% right along the bottom there. That would say that whatever scheme that we'd examined had no impact on GDP, whereas with the red line marked redistribution, which was the typical case of funding a basic income by withdrawing certain benefits and raising taxes, we end up with GDP that is slightly higher in our scenario than compared to the baseline, but it's really only slightly higher. That's 0.5% by 2035. And at that sort of scale, I would normally be telling you that the impact of that basic income on GDP is effectively neutral at that point. It looks positive from the modelling results, but it's not of a size that would be easily discernible to you in 12 years' time. So GDP impacts are neutral. You get a slightly more spending, but you also get slightly more jobs through that because the spending is higher, economic activity is higher. And what we're seeing here is, despite the slightly reduced incentive to work, the redistribution, which is progressive, it puts more money in the pockets of lower income households, generates slightly more economic activity, and that's propping up, actually slightly increasing employment. And the DFSM case, the sovereign money approach, which is injecting new money rather than redistributing income between households, that has a slightly higher effect, but again, I would interpret that as neutral or not obviously negative in terms of typical economic metrics. And in these cases, I haven't actually shown it, but inflation tends to be quite mild because at these sorts of levels of increase, slack in the economy is still being taken up. So increased spending is being absorbed by the excess capacity in the system at this point. Although that scheme design does matter because you tend to get more inflation if you start putting the taxes on the firms than if you raise the income taxes on households, because that tends to lead to at least some degree of cost price pass-through. But in both cases it's mild, but it does tell us that the scheme design starts to matter in macroeconomic terms. So moving through to a more, should we say, more dramatic case, then we now start to think about automation, so basic income in the longer term. And here we are constructing a future in which higher productivity automation can displace workers. So we're not arguing that it's more or less likely, but we're examining this scenario in order to see the role of a basic income in addressing a future like this if it were to come to pass. So for this, we have information that was taken from various PwC reports about the potential scale of job losses over the period. We modelled that and compared the impacts of the automation to a situation in which we still had the automation, but we raised basic income to try and return household incomes back to the original baseline levels. And in the model that we have, that scale of automation, that level of displacement of jobs can be quite adverse, because while it improves productivity and the productive capacity in the economy, by shifting money away from households because they're not gaining in terms of income, it's money that's accruing through profits, through to capital, that creates a situation of deficient demand in the economy. So households have less income, they spend less, and so while the economy could produce more, there's a lack of effective demand to maintain GDP at its original levels, but the basic income is able to fill that gap in this case, again with comparatively mild inflationary effects because there remains capacity in the system to absorb that extra demand. So the small scale of the inflation at this point is hopefully visible here in terms of the impacts from the green and the blue line, which are the small scale schemes, but also the way in which higher productivity can, compared to baseline, can reduce price increases, with actually automation having the bigger impact on inflation in those scenarios than the compensating effect of the basic income. So in both of these cases, the schemes that we've modelled and the adjustments we've applied to the funding mechanisms don't obviously lead to the kind of high inflation that was feared or has been cast doubt about when people are talking about basic income in isolation. Just quickly on what we can and can't say about these results. As an economy moves to an unconditional payment, it's unclear from historical experience what that might do to wage bargaining. So does that mean that people will be better equipped to walk away from bad job offers, or does that mean that firms will start treating that as wages they don't have to pay to their employers? There's not a huge amount of evidence there, so there's some uncertainty as to how that might play out, what that might do to the results. We say here no explicit assessment of exchange rate effects, but more broadly speaking, we're not modelling in any great detail financial mechanisms that might underpin some of these effects. But insofar as we're not seeing huge amounts of inflation, there's not obviously an inflation case for interest rates to change, and therefore through that channel we might not think that exchange rates might change too much. And in broader terms, because we've been looking at macroeconomic metrics only, we haven't really looked at the role of education and training in driving future productivity, and certainly in terms of the schemes that have been assessed in the real world, workforce withdrawal in order to invest in education and training is one of the known effects of some of these cash transfers. So the longer term productivity gains are not captured here, nor are the impacts on health and well-being from having an unconditional basic income versus the conditionality that's currently attached to most benefits. So in conclusion, at the small scale, there are not any obvious adverse effects for an economy operating below capacity of a basic income. Progressive redistribution of income tends to increase GDP slightly, or I would tell you that it's neutral. It seems to draw in a little bit more employment, depending on how positive you interpret that effect. And that impact comes despite a weakened incentive to work at a microeconomic level for households, which is an effect that in situating this would seem to be consistent with what's coming out of assessment of the Alaska Permanent Fund. The Alaska Permanent Fund is a wealth fund based on oil revenues in Alaska, with a dividend paid to citizens in the state depending on the returns each year. And similar effects were posited from evaluations of that scheme, in which there was evidence that there was withdrawal from the labour market, particularly in the switch to slightly more part-time work, but at the same time employment output outcomes seemed to be sustained, with the thinking that this came about from the income, the multiplier effects that follow from the basic income itself. So that's at the moment how we're situating the work, how we're understanding it. And in the automation case, in a future that we have modelled that erodes household income leading to deficient demand, the basic income scheme that we've modelled appears able to sustain household incomes without, again, adverse impacts on the macroeconomic indicators that we've been looking at. With this result resting on the idea that, structurally speaking, we don't think that the economy will tend to full capacity by itself. Now, as a structural, as a systemic reform, that seems like quite a comforting outcome if you're interested in the macroeconomic impacts of a basic income. But of course, we are in a high inflation situation right now. So structurally, the results here would seem to support that. But when I talked before about basic income scheme design, I think for this to be applicable right now, there remain questions about policy package design as well, because the basic income by itself is not necessarily going to do anything other than deal with the inadequate income. But what we haven't really examined here, what was not the point of the exercise, was understanding policies that might be effective in an inflationary environment as well. So while we haven't studied it, I think what this points to is, or at least it underlines, is the importance of the wider policy package, even if basic income looks to be an effective policy to address inadequate income. So I'll stop there, and hopefully I've done okay for time. But thank you for listening.
Thank you very much, Chris. Are there any questions of clarification before we move on to our next presentation? Yeah, there's one.
Thank you. I mean, just at the present inflation you've spoken about, I mean, wouldn't you agree that's the result of an exogenous shock? I mean, it's a global inflation. It's rather similar to the OPEC 1970s exogenous shock. It's not due to excess demand.
I think I would. I think in terms of sorry, is that on? Yes. I think that's right. And because of that, I think the structural case for basic income would be supported by these model results. But as far as how it might interact with the current situation, I think that still means that attention needs to be placed on other parts of the policy package.
Yeah, there's one more quick question. We'll have we'll take another presentation, and then we'll have a discussion. So we will have more time later. But now, please.
Two questions, really. Sorry, my name's Anne Gray, and I'm from the Citizens Basic Income Trust. When I read your paper, I started thinking about in what sectors automation takes place. And if automation takes place in some sector that sells most of its output overseas, then you would expect that the effect on job creation or job loss in the local, the national economy where the basic income scheme is happening would be minimal. So, I mean, that's one question I think to consider, how far the current output of British industry is export oriented, and what effects that might have, and in particular those sectors which are most likely to automate, like for example car production, one assumes are still very export oriented. The other thing which perhaps is a sort of line for further research rather than a comment on your paper specifically is if a government was in power that was likely to introduce a widespread or a national basic income scheme, it would surely be investing in loads of other things on the left side of the political spectrum as well. And those are likely to include a vast expansion of public services, which are notoriously difficult to automate. So that might have effects on the job creation and job loss effects of automation. So I just think that's something worth to consider. Thank you.
Yes, I completely agree with that. And how, I suppose, macroeconomic research on basic income, I think, remains relatively underexplored. Macroeconomic research on basic income as part of a package of other policies, I'm not sure I've seen anything on that so far. So I think that's very relevant. And I think I will have to withhold judgment on the first one, because the wage bargaining effect and some of these other factors start to come into a question as to how basic income could in principle affect the competitiveness of different UK industries. And I don't think I have at the moment a view as to which way some of those things would go, but I think it's a really interesting point.
So thank you, Chris, and please allow me now to introduce our next speaker. And our next speaker is